Yeah. Because economic being the highest weightage given in many of the sorry, in Karnataka examination is being very important. Kindly uh, note it. So one is monetary policy committee, marginal standing facility. What is bank rate and repo rate? What is quantitative easing? Helicopter money, and some of the recent development from these topics is very important. Very quickly, we can, uh, of course, we have read about what is MPC. Uh, Before 2016, RBI used to take, unilateral decision with some governor, with deputy governor. They used to decide many of the monetary policies, not the fiscal policies. Fiscal policy will decided by the finance ministry, and our monetary policy was decided by the MPC. And in the year 2016, they brought an act amending RBI Act. So they brought a MPC, which has six members, and the chairman will be the RBI governor, and three members will be appointed for a duration of 4 years, and they won't be any reappointment. They're not eligible for reappointment, and very important, six member they are constituted by. One more, before MPC was came, there was an agreement between the government and the RBI based on the recommendation of Arjit Patel committee. So that agreement, what we call is monetary policy agreement framework agreement. So through that, they have given a statutory status to MPC, and also one more important, inflation targeting. So government set a inflation so that it becomes the duty of the RBI to target it. So of course, inflation is being targeted based on the CPI, not WPI. Earlier it was WPI, now it is CPI. Very important. So inflation targeting meaning is that inflation targeting set by government every 5 years, so which RBI will achieve. But the target, it doesn't mean that you have to, it's a flexible, plus or minus. They have given 4%, but plus or minus 2% will vary it, because market forces cannot be predicted, cannot be controlled. Yeah, some of the terms are very important. See this repo rate and its types. So nothing but RBI gives a loan to the bank. So which is the RBI will give a loan to the commercial banks. So they charge a rate, some kind of interest when they give a loan. Is called as the Yeah, repo rate, and it's being given for the short-term period. So, of course, in order to take a loan from the RBA, bank has to give a collateral. Most of the time, the collateral would be government securities. So, remember, this term is very important, government securities. So, repo rate and its type. Types are not that much important, like overnight repo rate. These are all very much in depth, so will be useful for UPSC. Repo rate, when bank is increasing repo rate, it means it is increasing the interest rate. Very simple. So of course, when more interest rate, bank won't go to the RBI and take the money. When repo rate is less, definitely bank will reach the RBI and take more loan. So we can talk about monetary policy transmission as well, or in a later part we can see how this concept has arrived. So remember one more important concept. So reverse repo rate. Reverse repo rate is nothing but opposite of repo rate, where bank will park their money with the RBI. So in turn, RBI will give interest to the bank. Usually, reverse repo rate will be lesser in comparison with the repo rate. It means repo rate will be higher in compared to reverse repo rate. So this is very important. Uh, then uh, then marginal standing facilities. So it is kind of some repo rate itself. I understand here. So in case of repo rate, you have government securities, excess of government securities you will keep with the RBI and take the loan. But there is one more concept called as SLR, statutory liquidity rate. It's around 19 to 20%, where where the commercial bank has to keep in terms of cash or gold or government securities. When the bank is using these, understand, when the bank using these SLR part and going with the RBI and taking loan, that becomes marginal standing facility. It's kind of emergency situation arised to the banks. So now the government has, RBI has kept a limit up to 3% of your SLR. Suppose if you have kept SLR, so 20%, if you have kept, some 10 rupees as a SLR, which bank cannot use it for lending loan to the customer, up to 3% of that part they can use and take a loan from the RBI. That simple. MSF is the simple concept. Bank rate same as repo rate, but it is for the long term loan. When the bank is other, even bank rate comes for the larger context, even the government, financial institution, cooperative banks, when borrows money from the RBI for the long term, it becomes the bank rate. So of course, bank rate will be higher compared to repo rate. So then cash reserve ratio. So this is some part of the money that bank which has to keep with the RBI in the form of cash, where they won't get any kind of interest for the cash which kept with the bank with the RBI. So it's around 4% cash reserve ratio. So SLR is statutory liquidity ratio. As I told, bank has to, suppose bank is taking 100 rupees deposits. If I am keeping my 100 rupees in a bank, so bank will not lend that 100 rupees completely to customer. They have to keep some part of like 10%, 20% with the bank itself, and rest 90% they can, 90 or 80% they can give it as a loan. So statutory liquidity ratio is a reserve that kept with bank itself. CRR is a reserve that kept with the RBI. So don't get confused with these terminologies. Yeah, one more important concept, open market operations. So nothing but just buying and selling of government securities will happen by the RBI. So this is being very important. Then margin requirement. Suppose if I have 1 lakh gold as a collateral, so the bank will give me 75K, 75,000 as a loan. So the difference which gives is called as margin requirement. So 25K is a margin requirement, not that much important. So one more important, yeah, this quantitative easing is very important. Is also nothing but zero interest rate policy. So where when the times of crisis, especially USA saw 2008 financial crisis, where the central federal bank brought the interest to 0.25 rate. So it's called as where the interest is brought drastically or closer to zero, uh, is known as the quantitative easing. Also we can call it as negative interest rate. All this exist in the Western countries. So no need to focus because we'll context where context is from Indian perspective. Helicopter money is a very popular term. It's also one type of giving currency, printing currency and giving free of cost to the public. Of course, it's a rare event, so it's not that much important. So then targeted long-term repo operation. So this is one more important policy, new policy tool used by RBI to inject more liquidity into the economy. So of course, what happens here is liquidity available by the bank has to be deployed in corporate bank, commercial. So here, some RBI fixes some of the condition terminologies or some conditions. Look, if I'm giving loan, you have to give the the loan which you have taken to these sectors like commercial for borrowing, for buying these commercial bonds or commercial papers or corporate bonds, all these things. So as to, kind of manage the uh, economy, the money circulation. So how it is operated, e-Kuber, there is a portal where bank can go and purchase this. So then standing deposit facility. So one more word, uh, just like repo rate, this is RBI would not require to provide. See, usually what happens, we have to borrow money from RBI. So, sorry, if commercial banks wanted to keep their money, borrow money from the RBI, they have to lend as a collateral as a government securities. In this case, the commercial banks won't ledge or keep the government securities with, uh, instead of keeping, they won't keep the securities with the RBI. So this statement is called a standing deposit facility. Without keeping any government securities, RBI will give a loan to the commercial banks. So usually it will be higher than the repo rate. So uh, SDF would be lower than reverse repo rate. So this is as same as a reverse repo rate. So then foreign exchange sell or buy and swap. So nothing but exchange of dollars and all these things. Not at all important. One more thing, this last we can wind up monetary policy transmission. Whatever RBI taking, like reducing reverse repo rate, this has to be reflected to the customer. That is nothing but monetary policy transmission. So Operation Twist is one term associated with buying and selling of RBI G securities, where RBI sells short-term these G securities and buys the long-term um, securities from the public. So this is also some of to influence the money circulation in the market. So this being the last, we were not going as I have discussing this monetary policy transmission. Suppose repo rate has reduced, bank has to reduce the uh, interest on the loan to the customers. So this was the policy evolution. Earlier, this base rate regime prior to 2016 was there when MPC was not in existence, where bank used to calculate, rate of interest on deposit, cost of CAR, operational cost, expenses, all this taken into consideration, and they used to keep some profit, and they used to, that transfer that part of the benefit to the customers. Then after that, some lacunas was existed in the bank rate regime. Then came the marginal cost of lending rate. So this was again calculated on repo rate and rate of interest, all these things. Remember, this is very important now, which is operational is external benchmark of loans, or external benchmark of loans for all floating rate loans, we can call it as. So they calculate based on these parameters. So this is not to go in depth. Remember, now the present monetary policy transmission is based on external benchmark of loans. So yeah, this is for today economics. Hope this might be little bit boring, and because this part is very important for the